Hi friends, welcome back to the channel. Today I would like to talk about something that is more general. The topic that I would like to discuss is why you own stocks. If you ask Warren Buffett what is the most important rule in investing, he will tell you rule number 1, never lose money. Rule number 2, never forget rule number 1. I'm not sure what you feel about this statement, but it sounds a little strange to me. Why? Anyone who has been investing in the stock market for long enough will know that it is impossible to not lose money. Buffett himself lost over 50% from late 2007 to early 2009 and over 45% from mid-1998 to early 2000. Being in a drawdown is very normal, and that is the price you pay in exchange for higher long-term return than bonds or cash. But what he is referring to is the mindset of a sensible investor. Basically, he is telling us don't be foolish, don't gamble, don't go into an investment with an attitude that it is okay to lose. Be informed, do your homework. Buffett invests only in companies he thoroughly researched and understands. He doesn't go into investment prepared to lose, and neither should you. Peter Lynch has a famous line, know what you own and why you own it. If you don't get that right, you won't hold any investment long enough to reap the enormous benefits of compounding. You can have the best portfolio in the world, but if you don't understand what's in it, you will abandon it at the first sign of trouble. For example, during the COVID crash last year, so many investors sold their stock investment due to panic. If they are selling airlines, tourism stocks, that I could understand because the fundamentals have changed. But the reality is that the entire stock market tanked, even industry that benefits from the pandemic such as tech. This is because many investors own stocks without knowing why they own it, and when they feel panic, they just sold everything, even great company shares at bargain prices. And after the stock market recovered, some were still confused by why they sold it. In order to avoid that, we need to understand why we own stocks. Investors own stocks to participate in growth and creativity of human beings and businesses over time. In doing so, they hope to outpace inflation and earn higher returns. But what exactly does the last part mean? Higher than what? How much higher? And why are they giving you this higher return? Over long periods of time, stocks have delivered a higher return than bonds by 4.5% per year. And you were able to earn this return because you were being compensated for higher volatility and higher drawdowns. Table here is comparing 11 portfolios with different mix of stock versus bonds. Stock is represented by S&P 500 and bonds is represented by Bloomberg Barclays Aggregate. The historical data is from 1976 to February 2021. We are looking at 3 important metrics, namely annualized returns, volatility, and maximum drawdown. Both volatility and maximum drawdown are risk metrics. Volatility is actually a measure of standard deviation or the range of the returns. But most investors are not statisticians or mathematicians. If I tell you an investment XYZ has a volatility of 10%, do you have an idea how risky it is? Probably not. This is why I prefer the maximum drawdown to tell us how much a portfolio could lose from its peak, at least from a historical perspective. The table illustrates clearly the risk-return trade-off. If you want to achieve a high long-term return, then you should not put money in a bond or cash. 100% stocks will give you 11.8% return, but the maximum drawdown is 51%. I don't know how many of you have experienced a 51% drawdown. For me personally, I only started investing in stock market after the global financial crisis in 2009. Hence, I also have not experienced such a huge drawdown before. If a 50% drawdown is too much for you, what you can do is own some bonds or cash to help cushion the loss. Besides that, having some safe assets also allows you to buy stocks at a cheaper price when the market is at panic mode, such as during March last year. For example, a 50-50 stock bond allocations could lower the maximum drawdown from 51% to 27%, which is much more tolerable. How much risk to take and how high return to target is totally up to you. Everyone has their own risk appetite. Invest in stocks definitely give us higher return. The difference of returns between the stocks and bond is around 4.6%. Please bear in mind that the 4.6% outperformance here is based on historical period of 45 years. Over shorter period of time, the relative outperformance of stocks over bonds is not guaranteed. And by shorter period of time, it could be as long as 10 years. For example, from April 2000 to March 2010, stocks declined 6% while bonds gained 84%. The gain in bonds came from both the coupons and the drop in interest rates. Understand this is critical in setting realistic expectation. If you can't handle a large drawdown or can't tolerate years of underperformance in stocks, then please don't invest all your monies in stocks. Diversify your assets to other asset classes such as bonds, cash, real estate, etc. Back to the reasons of owning stocks. We all invest in stocks to get higher return, at least higher than bank deposits like FD and other safe instruments like Singlife, Dash, Singapore Saving Bond, etc. Indeed, if you have invested in S&P 500 since January 2009, you have gained 449% with only one down year, a small loss of 4.4% in 2018. That's a gain of 15% per year compounded over 12 years. And you can easily access the S&P 500 via SPY or VOO ETF. Here you can see that the past 10 years of return is close to 14% per annum. Back to the chart, do you notice anything that is strange? People always say stocks are risky and volatile, but this chart looks quite smooth, only except for the dip in March 2020. This really looks like an easy ride, but anyone who has invested in stocks market in the past 10 years or so would definitely tell you that isn't the case. Since March 2009, there were 27 corrections of more than 5%. Of these, 10 were larger than 10%, 3 exceed 20%, and 1 was more than 30%. And these are not just small crises that people just brush away as something that is temporary. At the time, investors are seriously worried that it could turn out to be a bigger crisis. I mentioned about the COVID-19 for a couple of times because the memory is still very fresh and we are still living in the pandemic period. Let's take a look at the Europe debt crisis in 2011. At that time, some even suspected that the euro might break up. During the panic period, Germany bond yield dropped from 3% to 1.8% and the DAX index dropped by more than 30% in a couple of months. Of course, the euro breakout didn't happen and the stock market continued to rally afterwards. The point here is that during panic period like this, if you don't know why you own stocks, then you will be influenced by the news headlines and sell at the bottom. For me personally, I don't see stocks as a speculative trade. Each stocks represent the ownership of a fraction of a business that is operating constantly to provide value to customer, and in the process of delivering value, they also earn some profits. These businesses are growing by expanding their product and services in the local market or to more countries. Sometimes they create new lines of business when they see area of growth. These businesses spending monies on research and development, strengthening their moat so that they stay ahead of the competitions. And these are not just theory. Every quarter, these companies will announce their quarterly financial reports and you can see how well they execute. Take TSMC as an example. Their operating result was just released a few days ago. Net revenue increased by 16.7%, which is very decent growth rate. I guess the average annual increment for a salaryman is not even half of this growth rate. Of course, if 16% growth is too low for you, you can always buy higher growth companies like Tesla, Nvidia or Palantir. Please note that high growth company is valued at a high valuation, hence they will need to exceed this high expectation in order to give the investor a good return. The bottom line is, please treat these stocks as businesses and monitor the fundamentals and not the share price. Share price always goes up and down. If it goes up a lot, that's good for you. If it drops, just treat it as a good opportunity to accumulate. However, you have to make sure that the company that you have bought have good fundamentals and not just because of hype. This way, you won't be affected so much by the news headline and be able to tolerate huge swing in the stock price. You can even take advantage when the opportunity comes. Alright, please let me know what do you think. If you have any topics that you would like me to cover, please let me know in the comment below. Feel free to join the Telegram group too, link in the description. Also, most of the content in this video was taken from Compound Advisor website. Great contents there, I'll provide the link in the description. That's all for today's and see you in the next one. Cheers!